Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today I'll be looking at PayPal stock. This one came in by request. If you have a stock you would like me to analyze on the channel, just put it down in the comments section. I'll get it on the whiteboard behind me and eventually I will make a video of it. If it's a stock that's in the S&P 500, I post those here on YouTube for free. If it's not, I post those on Patreon, which is $5 a month. And if you join there, you can get a big discount to my full service where you get access to all my spreadsheets, chat room, tons of articles that aren't available to the public, macro updates, pretty much anything and everything that you could want. Those links will be in the description. As always, this is not investment advice. This is just how I personally analyze stocks. Now, at the beginning of 2021, was when I first started this channel. I only posted videos for about 3 months before kind of taking a break and reviving it earlier this fall. But PayPal was one of the stocks that I covered back then, and it's good to go back and kind of look at any coverage I've had of a stock, I think, in the past, which is something I always try to do because I don't tell a lot of stories usually when it comes to these businesses. I'm mostly looking at them from an earnings perspective and what future earnings might do. And really a lot of the things that the financial media talks about aren't important to me for the time frames that I'm looking to invest in a stock, which is usually at least 2 years, and for most stocks, and like 2 to 5 years is kind of the time frame that I want things to come together by. And then with some, they become longer term holds. But so I'm not as much a trader as I am an investor, but I do sell things when they get overvalued, or if it's a cyclical, I'll try to sell during the tops of the cycles and buy during the bottoms of the cycles. So I made a sell video. You can see why it's time to take profits in PayPal on February 5th, 2021. So we're getting almost, into year 3, almost 3 years now ago. And this is what the fast graph looked like at the time that I made that video. And let's see, they had a PE of 74. The expectations for earnings were 2023. This year they were expected to earn, these are adjusted earnings, $7.15. And I was basically putting out my sell call on this one. So we can see how that's done. Let's see how I want to do this here. Let's go to fast graph. So we're back to a modern day fast graph of what actually happened. So I published that video in February, very beginning of February, right there actually. And since then the stock did not earn the $7 that was expected in adjusted earnings. They're closer to $5, and the stock has fallen almost 80% since then. So I'm going to call that a pretty good sell call. Now, over on Seeking Alpha, which is where I write, I have covered PayPal a lot, but they've all been these neutral ratings since the peak. And really what I was doing was, I did warn people about tech stocks, even though this is rated a hold, still at the end of 2021 there. But basically I followed PayPal stock on its decline here as it got cheaper and cheaper, telling people where I would probably be willing to come in and buy this stock. And then since earnings and everything kept getting adjusted down, I just kept adjusting everything slowly down, and I never really, you can see it's nearing my buy price, and then here I'm talking about the factors that we should consider before buying. And so I have never bought this stock yet, but it's one of the few ones where I was able to warn at the top, and it's at least like getting interesting now, which is probably what I'll end up titling this video. So I haven't bought this one. I think I wasn't ever calling a top, but my sell call was near the top. So an investor would have been wise to avoid the 80% drawdown. Um, so now let's see where we stand today. So I usually check historical cyclicality. With PayPal, we don't have a long history that actually has a real recession in it. So we don't really know how cyclical their business is. They were part of eBay. I went back and checked eBay's history, and they back in 2008 they weren't particularly cyclical. Excuse me. So I would say we don't know what the cyclicality is until we really see. We do see this coming off of the COVID boom, which they had good growth, but they had good growth going into COVID, like 20% growth, earnings growth. But then we see this decline here coming out of the boom. So we know there's going to be some cyclicality. We don't really have any evidence to squarely say what a recession will do to their business. I will say they have a lot of competition. I think from a practical point of view, to me, it's going to be hard for them to compete with like an Apple when they have Apple Pay that's so convenient. I mean, I pay with everything with my watch now. I mean, not everything, but if I go out for a walk or I run to the store to grab something, or if I'm just don't want to be, if it's the summer, I don't want to carry a bunch of stuff around. The ability to just pay for things with your watch with just a couple clicks is pretty amazing. Even if you're eating dinner, you don't have to dig out your wallet or anything like that. So I'm not sure how well PayPal can like ultimately compete against that, but they do have. They are well established. They are everywhere. They have. I think they do the Venmo too. So one way to think about it is usually when people are talking about like Apple ecosystem people, usually they're a little bit more like moderate to high income. And I think PayPal may have a place. And usually when I see people Venmoing, it's not the same people that are using Apple. Like, I mean, I hate to make like a super generalization about that, but so it does make me wonder if their business will be, well, one, they might be able to have their own niche, so that's a good thing. But I think the niche might be a consumer that's more vulnerable to economic conditions. That would make their earnings more cyclical potentially. So we don't have evidence yet that we can say for sure, but I think we should be aware of that and be cautious that these we've seen earnings have not met expectations. If we have a recession, they could keep not meeting expectations. So we want to be pretty careful of that. And so that's just something to think about. I don't usually get into like the business stuff too much, but I think in this case, since there's an unknown and we don't have the evidence, we have to think about it a little bit more. So I'm going to treat this with caution, but I'm just going to look at what the earnings and stuff are doing today. But because I'm being cautious. I'm going to use basic earnings because they're a little bit more conservative. They come in at 375 instead of 498. So that's just one way to be a little bit more conservative. And then even though they've grown earnings maybe like an average of 20% or something, let's go back to adjusted for a second. I'm assuming adjusted earnings, or just earnings, however we want to use them, are going to grow at 10%. They can grow at 10%. I mean, this is a big company this is for the next 10 years. So we're talking almost a $60 billion company. I think it's reasonable if you want to take a shot to assume whatever earnings bottom, that's what we don't know, that after that they could grow at 10% a year. So that's the assumption I'm making, roughly based on analyst expectations, but I kind of brought that down myself before the analysts brought it down. So that's what I'm working with here. So with that, let's look at the numbers. I have a 10% earnings growth. I'm using the more conservative basic earnings here. So instead of, let's see what Fast Graphs has. Well, they might actually have it. Nope. Yeah, so that's 16 PE instead of 11 or 12. So that's more conservative on our end because we're assuming it has a higher PE, which is 15.5 is what I have here. So with that in mind, that produces an earnings yield of 6.43%. And we're going to take that earnings yield along with a 10% earnings growth rate and see if we own this business and collected all the earnings for ourselves, how much money we would have after 10 years. So first year we get 643 plus 10%, so 708, and that 708 grows at 10%, and we collect it each year and it adds up, accumulates for 10 years. So on our $100, we could turn it into 212. And that works out, if you put it in a CAGR calculator, to 7.84%, 10-year CAGR expectation. Assuming these are reasonable estimates, which, you know, who knows? But you got to try to estimate a little bit to give yourself, at least to get yourself in the ballpark. So when this is above 8%, that's usually my buy threshold. When this CAGR is above 8%. This is the current price, so it would cross that threshold if it fell below $56.70, less than 3% away. So it's right at that line basically right now, which just kind of makes it interesting. Now, if we look at my note here to everybody, I say let's give this some time to see how the momentum factor plays out. So because we don't know what's going to happen with earnings, especially if we have a recession, we know they're going to have stiff competition. They've also gone into kind of other businesses like buy now, pay later, although I think they sold some of that business off. Haven't been following everything really closely. It looks like they're making adjustments to try to de-risk a little bit, which is probably good. But what I want to see is, this is a momentum factor from Seeking Alpha. If you're a member on Seeking Alpha, I think you get access. This is one of the things you can get access to. Right now it's a D-, so the lowest is an F. So its momentum score is very bad. What I would want to see is this momentum score get a B- or better, and then also have this be 8%. So really what I want to see is this stock price come down below my buy price, level out, and start to come up and not really exceed my buy price. Now it's possible my buy price could rise if earnings rise next year. So it can go up from here. And if we take a look here, let's just take a look. We'll look at the normal version. So we have one more quarter. Right now, analysts are expecting like 10% growth next year, but who knows? This will all get adjusted. But you can kind of see what I've been waiting on when you look at this chart. I use the momentum factor to avoid this crash, because when this happened, everybody thought earnings were going to be like up here, right? But they ended up not. So I want to wait for that to bottom, okay? And then when it comes up like it did here, I still want it to be cheap. So I don't know if it ever crossed it's been like right on the borderline this entire way down, which is one reason why I've written so many articles on it. But you can see why. I mean, if you would have bought here or anywhere above, but even if you would have bought on that bounce, you'd be down 44%. So you really want to be careful. And to me, it's more important to miss this downside than to try to pick the exact bottom. So, I mean, it's only 11% off the bottom right now. So if we see, I'm going to guess that we're going to be into next year probably before this happens, but if earnings expectations improve, but the stock price doesn't rise a lot, but it rises enough and enough time has gone on that it's kind of formed a bottom, then I would consider coming in with a small position. And that's how I am treating it, and that's how I would treat it. But a lot of it has to do because we don't really know what's going to happen, and I don't feel like there's a rush. I've kind of felt that way this whole time, and I've been right. but I don't feel like this is one that's just going to take off and get away from us with justification for that anyway. All right, if you enjoyed this video, click the subscribe button, and I will see you guys later. Bye.